people have the assumption that when they make a deposit, that's their money, but it's not. When you make a deposit, legally, you are loaning your money to the bank. And in 1995, they enacted Regulation D, which legalized and enabled the banks to sweep your deposits into sub-accounts that are in the bank's name, and then use that as collateral for loans. And, frankly, most of the revenue that the banks generate right now is trading revenue, according to the Office of the Comptroller of the Currency. So that just enabled them to reduce their reserves and to use your money to gamble with. You don't even realize it because it's invisible. If most of their revenue is generated by trading and not by lending, and remember right now, central banks are raising interest rates to fight the inflation that they caused by their reckless money printing, right? Absolutely. And, and by the way, even though this says this is prop money, what are the ones that are issued by the governments? It's garbage. Right. Gold is real money, right? Everything else is just an imitation of it. But what we're seeing in the banking system is as they raise the interest rates, the system is falling apart because it's really been based upon a never-ending compounding of debt. And so the interest rates have been in a steady decline since the early 80s, and now they're anchored at zero. And central banks, when they tried to raise the rates in 2016, it was a big fat fail into 2019, wasn't it? They tried to raise the rates and then they couldn't. They dropped them all the way down. Now, with what they've done with interest rates, we've actually broken that, 40, 50-year trend line? That's significant. Anytime there is a pattern shift, you don't even have to understand what that means, right? But when there's a pattern shift, what that's telling you is that there is change afoot. And the bigger that pattern shift is, the greater the change that's coming. What they did in Cyprus too, the first bail-in took everything. They ignored the deposit insurance scheme, which in the US was put in 1933 to get people comfortable with making the deposit in the banks, right? So they actually enacted that, and at the same time, they separated investment risk-taking banks with deposit-taking banks. And then in 99, they eliminated that separation. So in 95, they enabled Reg D, which allowed them to sweep those funds underneath. And then just a few years later, they allowed the merger of risk-taking trading banks with deposit-taking banks. And now Wall Street really has full access to your deposits. It is a crisis, and a crisis of confidence. So if you attempt to run on the banks, well, they're going to stop you cold. And if we go back to what was happening in 2008 and 2009, people were losing a lot of confidence because of that crisis, right? But I think that what's really interesting, using Cyprus as an example, because that's really where they tested it. Number one, you can see where the French and German banks had been investing a lot of money in Cyprus. And then all of a sudden, in 2011, they took that money out. And so it looks like this peak like that. But the average person, the saver, this is what they call sticky money. So in other words, you're going to make that deposit and you ask yourself, when was the last time you changed banks? You don't. So that's really what makes you vulnerable, because you have confidence in the bank. You have that relationship. They don't want you to know. And you might also recall that you had all these central banks bankers come out and do this whole floor show. You don't have to worry about your money in the bank, because there was a run that was starting. We can print as much money as you want. You can have all the money you need. And that's how they stopped it, by just printing more and putting it in the banks. They have a program that they formalized called perception management. And that is managing how you perceive things so you move forward in the manner that they intend you to. But they like distance between their policies and how you receive them so that you don't understand that it's all the central bank policy, because then you might say no. And they don't want you to say no. They want you to volunteer.
Perception management is a point that you highlighted in one of your recent segments where you actually played a clip from a recent FIDC.
It's incredible to me that they are so open in this age of the internet. But yes, I mean, they're laughing at us. No, normal retail clients, they don't need to understand that there's really no money in the FDIC DIF fund, which is the Deposit Insurance Fund, and they should be expected to be bailed in. But if you talk to the normal person, do they even know about the bail-in? And remember too, in Cyprus, first they just bailed everything in, and it wasn't until everybody in the rest of the world went, but what about the deposit insurance scheme, that they backed that out, though people in Cyprus, the normal person in Cyprus, did not have access to their money until 2015, other than a little bit every day. And if you listen, in that clip, they talked about the fact that the institutional investors, the sophisticated investors, hey, they have their lawyers here, they have their accountants here, so they'll understand, just like the French and German banks got out before the bail-in, leaving the average person who is just about the right size to fail in the system and bailing in their money. I think what could definitely cause the bank to fail is what we have coming up in June of this year, 2023, which is that transition from LIBOR, that interest rate benchmark that was created in the 80s and is in every single contract out there, to, in the US, it's SOFR, but in different countries, there are a few other transitions. And the problem with SOFR, that's the one I can speak to the most because it's the one I'm most familiar with, but I'm sure this is probably pretty accurate for all of them. The interest of the SOFR is different than the interest of the LIBOR.
London interbank offer
rate. You had a small group of banks that would get together and say, well, if I was going to borrow money overnight, this is how much I'd be willing to pay. And if I were going to lend you money overnight, this is how much I would want. And that's how that rate was established. So that's pretty darn easy to manipulate the rate. And I don't know this for sure, but my guess is if that had not been leaked to the public that it was being manipulated by the Wall Street, then we would still just be on LIBOR, because never in history, never have they done this large a transition. And the most current data that I saw on that, there are $610 trillion in notional value contracts that still have to transition by June 30th of this year. And when they tested it in October, I think it was 2019, with $80 trillion in contracts, it was a big fat fail. And you know that because this transition was originally supposed to happen in 2021, and they postponed it to 2023.